This morning, Wall Street is on watch. The stock market finished its worst day yesterday since the financial crisis of 2008. The Dow Jones Industrial Average plunged more than 500 points. The fear here is twofold. One is the possibility of the U.S. economy heading into another recession, and overseas, Europe's debt problems are getting worse. Joining us to discuss the fears, realities, and what could happen next is economist Peter Morici. Peter, thank you so much for joining this morning. Good morning to you.
Nice to be with you.
Biggest sell-off since the financial crisis of 2008. What happened?
Well, there's great fear that the European banks are in considerable trouble. The sovereign debt crisis has spread to Italy, and Italy is too large to rescue or digest. There's going to be major bondholder losses if Italy goes into crisis. And in New York, of course, there's real concern. Those GDP numbers from last week are sinking in, and there's a real concern that the U.S. economy is starting to dip into a second recession.
All the Dow's gains so far this year wiped out. Manufacturing is down. Consumer spending is down. Are we headed into another recession?
Clearly, the economy is in neutral. All the data that we've received over the last, say, month or so indicate the economy has slowed to zero growth. Whether it's slipped into a recession, that it is actually contracting, we just don't know. But the economy is behaving very badly, and it's right at the cusp.
Now, how much of this do you think has to do with the consumer psyche, what people are thinking? A lot of people that you talk to, if you ask them, are we headed to another recession? Many of them would say, did we ever come out of one in the first place?
There's no two ways about it. Over the last, say, 3 to 6 months, consumers have been spending a lot less. You know, in the first 6 months of the recovery, the consumers were there. Now they've basically gone home. Retail sales are hardly moving.
Economic growth for the first and second quarter pretty much anemic, not moving anywhere. Can it be fixed? Is there a way to fix it? Are we out of options?
We're not out of options, but now they get unpleasant. The big things that we could do would be to finally do something about our trade deficit, which comes down to oil and trade with China, because that saps off so much of what we spend that doesn't come back to buy American products. With regard to oil and gas, it means reversing Obama administration policies to slow drilling in the Gulf and actually speed it up. At $100 a barrel, America could be energy independent. And over a period of 2 to 3 years, that could give the economy a real jump start. Privately funded infrastructure projects. You know, that's essentially what oil and gas development are.
Let's talk about jobs. We're going to get that jobs report later on today. What can we expect?
Well, the consensus says about 75 to 85,000 jobs. We need 130,000 to keep up with adult population growth, you know, young folks coming of age. So that's really rather anemic. And looking down the road, all the layoffs that have been announced, they will not be present in that July report. We'll start to see those in August, September, and October. So the jobs reports are going to stay poor for a while.
And let's talk about me for a second. If I, after today, have investments or a 401k, what advice would you give me moving forward?
Well, you're a relatively young person. Essentially, anyone under 50, I'd say ride it out. You know, we have been through crises of this kind before. America is not over. It wasn't just the Great Depression. There have been other similar crises, and we'll get through this. And by the time you retire, that 401k will be an 801k. Now, older fellows like myself should have a considerable amount of cash so they can get through, say, at least 5 years. They should have assets of that amount that are fairly liquid.
Alrighty, economist Peter Morici joining us this morning to talk all about what's happening on the markets. Peter, I'm sure we'll be in touch. Thank you so much.
Take care.